So hello everybody, this is Professor Tallarico, and I want to jump ahead a little bit, and I'm going to do something a little backwards. Instead of covering Chapter 2, I'm going to cover Chapter 3, because a lot of the concepts on the Zoom project require a lot of work from Chapter 3. So I will go over and make a video of Chapter 3. However, there are about 70 slides on here, and the video will get very long. So I will probably chop it up into 2 videos or so with about 35 slides of each and then put them up. So it'll be Chapter 3 Disc 1 or Chapter 3-1 and Chapter 3-2. All right? Or video Chapter 3, 1 and 2. All right? So I hope everyone's clear about that. So I kind of want to go over some stuff here a little bit. And we're going to look at 4 financial statements. 4. And we're going to look at a bunch of ratios, and you need these to evaluate how well your Zoom company is doing against all the others. All right, so the first important slide here is what's known as the General Accepted Accounting Principles. And these are the practices and procedures to prepare financial records, and they're authorized by the Financial Accounting Standard Board, otherwise known as FASB. Okay, so this is all going to lead up to the stockholders report. So there were a lot of things that went on with accounting scandals in the early part of 2000 and so. And so the Sarbanes-Oxley Act of 2002 was passed, and this allowed companies to have to pass disclosure and sign conflicts of interest agreements so they could be eliminated, and that was all done to avoid any games that were going on and to protect the interests of the investors. So you can see this important statement right here. The PCAOB is charged with protecting the interests of investors and furthering the public interest. Basically, they don't want companies to lie and play games and prevent scandals. So you should be aware of that. And you should know what the Sarbanes-Oxley Act is. You can go up on Google and probably download that document. Okay, so what's important here, and very important, is that public corporations with more than $5 million in assets, hard assets and long-term and short-term, and more than 500 stockholders are required by the Securities and Exchange Commission, which is a federal agency to protect stockholders, to protect their stockholders with an annual stockholders report. And I want to highlight that. What's important here is an annual stockholders report and what's known as the Securities and Exchange Commission. Okay, so that's important, so you should know that. Okay. And also there's an international financial reporting standards group, but it's not as regimented as the American financial reporting standards. So I suggest you you can read this, but bear in mind that that the American General Accepted Accounting Principles are more rigorous and more detailed. As you can see, it's stated right here. Okay, and it's all stated in there right there. So I will highlight that. And again, I'm going to skip the ethics portion. Okay, so the 4 key financial statements, and as I said, there are 4 financial statements here. And it's important to know there's 4. And the first one is the income statement. And this provides a financial summary of a company's operating results during a specified period. And basically, it starts out with the revenue up on top. Revenue is the sales that you made. This would be equivalent to your paycheck on a personal level. And basically, they are generally, they're computed monthly by management. And for tax purposes, you can see here they're reported quarterly, but they also do an annual one. So it's important to know about an income statement and what it does. Okay, so here's a sample income statement from your book. You will notice right here that on the very top is the sales revenue. Okay, that's the money that you brought in from selling your product. And here's the cost of goods sold. That's what it costs you in workers and parts and material to make that part. If I subtract these two, I get the gross profit. Does everyone see that? Just subtract the cost of goods sold from the sales revenue. And then we have all the operating expenses here, right? And then you total up all the operating expenses, and that gives you this number right over here, okay? So if you add up all these, you'll get that number. And if you subtract the operating expenses from the basically the gross profits, you will get basically your operating profits. Okay, so again, this is just a subtraction. Interest expense is simply the amount of interest you had to pay on bonds. Bonds are debt, okay? Companies issue bonds so they can borrow money from people, and they will have to pay interest to the people they borrowed from. A bond is unique in that the person who lends you the money has no say. They basically just loan you the money, and there's no voting, no say, and that's all it is. After I subtract the interest from the operating income, I get my net profit after taxes, and then I subtract off my taxes here, right? And it all depends on your tax rate, and then I'm left with my net profit after taxes. Okay? Now, I may have preferred stock dividends. Preferred stock dividends are dividends on what's called preferred stock, and that basically is issued and has a higher level than common stock. Basically, superiority-wise, the bondholders will get paid first in case of a problem. Then comes the preferred stockholders, then the common stockholders, okay? So after I subtract off the dividends to the preferred stockholders, I'm now left with earnings available for the common stockholders, and I divide that number by the number of shares, and I'll get the earnings per share. And out of that number, I may or may not pay dividends to the shareholders. It's no guarantee that there's going to be a dividend. So someday, if you buy stock, you have to determine whether or not there's going to be a dividend paid. Okay? If you have any questions on that, please email me and read the book. Okay? So here's a personal finance example. This is a personal item of which you should look over, and it's just it looks at all your salary, which is here's the revenue, right? And here's all your expenses, and here's the interest you received and your dividends. So this is your total income right here. Okay, so the next one is the balance sheet, and this presents a summary of your financial position at a given point in time. So the balance sheet, and I'll highlight that, is important because on the balance sheet you're going to have two columns, assets and liabilities and stockholders' equity, okay? And what's important is the assets on the left has to equal the liabilities and stockholders' equity on the right. And I will make a point of that. Okay, so here's the assets. This is the left side of the balance sheet, and you can see that in your book, right? Assets. And they start out with the most liquid assets first. Nothing is more liquid than cash, right? You have cash, and then you have marketable securities, which are stocks you may own in another company. And everyone should know what accounts receivable is. If you don't, let me explain that to you. When people buy stuff from you, they haven't paid you yet. It's kind of like, Life is waiting for you to pay their bills, right? And then we have inventories that we have that we spent money on. So these are all the short-term assets that we have, and we call those items total current assets. Okay, so we'll add up all those items, and if you see here, add these all up, and you should get this number here. Okay, then we have the fixed term assets, land and buildings, long-term fixed, and any machinery that you buy to build your product, and cars and vehicles and furniture and fixtures and computers. And a lot of these basically, you can basically deduct the depreciation from as they age. So we'll learn about depreciation at another time. And if you have any financial leases, right, that's part of your long-term assets. So here's your total gross fixed assets at cost. At cost means what you paid for them. Okay, now as I just said, we have depreciation. Now you got to subtract off all the depreciation as things age, and this is accumulated over time. Okay, so my net fixed assets after I take off the depreciation are worth this. You can see this was subtracted from my gross fixed assets. So my total assets are now the current assets here plus my net fixed assets, and if you add this guy right here, 1223 to 2374, you should get this total assets. And you'll notice they did it for 2 years, 2015 and 2014. But that's immaterial. Okay, so I hope you're clear. Once again, if you have any questions, email me. So let me move on a little bit now. Okay, here's the liabilities and stockholders' equity. So now we're on the right side of the statement, and we'll look at that. And on the very top is accounts payable. This is short-term liabilities. This is money you owe on stuff you purchased, okay, to your suppliers that you haven't paid yet. And here's the short-term notes, like short-term loans, right? This is basically the liability that you have to pay the people back on the money you borrowed short-term. And here's the total accruals are wages and salaries and your bills like your LIPA bill. And you could get all that. So if I add up these three items, I'm going to get my total current liabilities. And if you see these three right here and add them up. All right, here's your long-term debt. Remember what I said? These are bonds that you still owe out. Basically, you have to pay the bondholders when they come due. So if I take my current liabilities and my long-term liabilities right here and add them up, I get my total liabilities here. Okay, so now we have the stock. This is the amount of preferred stock that I borrowed, right? And you'll notice that it's 200. By the way, this is 000. So this is all of this is multiplied by 1,000. So this is 200,000 I issued in basically preferred stock. After that, I've issued common stock. This was the original at the par price. Par is an arbitrary number that they use to value the shares. So you can see here $2.50 per share, right? The authorized shares were 76,200. I'm sorry, 100,000 shares were authorized, and the amount of shares issued and outstanding was 76,262. So they can still issue another basically $23,738 in shares. Okay, now. This is very important, and please make a note of this and read this in your book. Paid-in capital is in excess of par, is how much the stock was sold for, okay, above and beyond this arbitrary par value that was created. So the actual book value of the shares are the total of 191,000 plus 428,000, okay? Here's the retained earnings. This is dividends on the earned income that were not paid to the shareholders. You kept that in the company, okay, to pay to make the company grow. So my total stockholders' equity is the sum of 200, 191, 428, and 1135, and it adds up. It should all add up to 1954. Okay, so my total liabilities and stockholders' equity is 1643 plus 1954, and you should get a total of 3597. If you add that and you add that. All right, so I got about a 15-minute video for you to go over here, and I will add up another bunch of slides later, okay? So for now, please review these two statements, and if you have any questions, please get back to me. Okay, and I'll pick it up from the next slide, okay? All right, see you later. I hope everybody's clear. Let me know if you're not.